What is the S&P 500 index? The S&P 500 index, or Standard & Poor's 500 index, is a market capitalization weighted index of 500 leading publicly traded companies in the U.S. It is not an exact list of the top 500 U.S. companies by market cap, but there are other criteria that the index includes. Still, the S&P 500 index is regarded as one of the best gauges of prominent American equities, performance, and by extension, that of the overall stock market. The S&P 500 index features 500 leading U.S. publicly traded companies with a primary emphasis on market capitalization. The S&P 500 index was launched in 1957 by the credit rating agency Standard & Poor's. The S&P is a float-weighted index, meaning the market capitalizations of the companies in the index are adjusted by the number of shares available for public trading. Because of its depth and diversity, the S&P 500 is widely considered one of the best gauges of large U.S. stocks and even the entire equity markets. You can't directly invest in the S&P 500 because it is an index, but you can invest in one of the many funds that use it as a benchmark, tracking its composition and performance. The weighting formula and calculation for the S&P 500. The S&P 500 uses a market cap weighting method, giving a higher percentage allocation to companies with the largest market capitalizations. Determining the weight of each component of the S&P 500 begins with adding up the total market cap for the index by adding the market cap of every company in the index. The S&P 500 is a member of the S&P Global 1200 families of indices. Other popular indexes include the S&P Mid-Cap 400, which represents the mid-cap range of companies, and the S&P Small Cap 600, which represents small cap companies. The S&P 500, S&P Mid-Cap 400, and S&P Small Cap 600 combine to cover 90% of all U.S. capitalization in an index known as the S&P Composite 1500. The S&P 500 is one of the most widely quoted American indexes because it represents the largest publicly traded corporations in the United States. Another common U.S. stock market benchmark is the Dow Jones Industrial Average. The S&P 500 is often the institutional investors' preferred index given its depth and breadth. While the Dow Jones Industrial Average has historically been associated with significant equities from the retail investor's point of view, institutional investors perceive the S&P 500 as a more representative of U.S. equity markets due to its compromises stocks across all sectors 500 versus the Dow Jones 30. Furthermore, the S&P 500 uses a market cap weighting method, giving a higher percentage allocation to companies with the largest market caps, while the Dow Jones Industrial Average is a price-weighted index that gives companies with higher stock prices a higher index weighting. The Nasdaq is a global electronic marketplace for trading securities. There are several equity markets that include stocks traded on the Nasdaq. Note that a given stock included in the S&P 500 index may also be in one or more of the various Nasdaq indexes. The S&P 500 is a member of a set of indexes created by Standard & Poor's. The Standard & Poor's set of indexes is like the Russell Index family in both that are market cap weighted indexes unless stated otherwise, as in the case of equal weighted indexes, for example. However, the two large differences between the construction of the S&P and the Russell families of indexes are that first, Standard & Poor's chooses via a committee, while Russell Indexes uses a formula to choose stocks that they wish to include. Second, there is no name overlap within S&P style indexes, growth versus value, while Russell Indexes will include the same company in both the value and growth style indexes. Now looking at the S&P compared to the Vanguard 500 fund. The Vanguard 500 fund seeks to track the price and yield performance of the S&P index by investing its total net assets in the stocks, comprising the index and holding each component with approximately the same weight as the S&P index. In this way, the fund barely deviates from the S&P, which it is designed to mimic. The S&P 500 is an index, so it can't be traded directly again, but those who wish to invest can invest within companies such as ETFs that track the index, for example, the Vanguard 500 ETF, also known as VOO. Now we will be taking a look at an example of the S&P 500 and how an underlying stock affects the index as a whole. The individual market weighs must be calculated by dividing the market cap of each company by the total market cap of the index. And now here's an example of Apple. So Apple reported 16.71 billion basic common shares issued and outstanding in their October 2021 annual filing, and had a stock price of $173 as of February 15, 2022. Apple's market cap at the time of this writing was 2.28 trillion or 16.32 billion times $173 as of February 15, 2022. The 2.82 trillion is used as the number in the index calculation. The S&P 500 total market cap is approximately 40.15 trillion as of January 31st, 2022, which is the sum of the market caps for all the stocks within the index. Apple's weighting in the index was approximately 7% or 2.82 trillion divided by 40.15 trillion. Overall, the larger market weight of a company, the more impact each 1% changes in a stock's price will have on the index. You may be asking, why is the S&P called Standard & Poor's? The first S&P index was launched in 1923 as a joint project by Standard Statistical Bureau and Poor's Publishing. The original index covered 233 companies in 26 different industries. The two companies merged in 1941 to become Standard & Poor's. Now taking a look at who qualifies for the S&P 500. In order to be included within the S&P 500 index, a company must be publicly traded and based in the United States. It also needs to meet certain requirements for liquidity and market capitalization. Also have a public float of at least 10% of its shares, and have positive earnings over the trailing 4 quarters. So now that you have built a great understanding of what the S&P 500 is, you may be asking yourself how you can invest. And the simplest way to do so is by investing in an S&P 500 index. These funds invest in a cross-section of the companies represented within the index, and what they are meant to do is mimic them in their overall performance. The S&P 500 index is one of the most widely used indexes for U.S. stock market. These companies represent the largest and most liquid companies in the U.S., from technology and software companies to banks and manufacturers. Although the index was created by a private company, the S&P 500 is now a popular yardstick for the performance of the market economy at large.